In this chapter, Graham lines up 8 pairs of adjacent listed companies and compares them. Similar names or businesses, but wildly different outcomes, financial structures, and market prices. The point is to show how price and quality can diverge, how markets reward growth and glamour, sometimes irrationally, and how simple balance sheet and earnings checks often separate sensible investments from speculative traps. Each pair is a short case study. Pair 1, Real Estate Investment Trust, REI, versus Realty Equities Corp. Contrast: REI is an old, conservative trust with steady dividends and modest growth. Realty Equities is a fast-growing conglomerate that exploded in assets and debt, issued weird preferreds and warrants, and then imploded. Lesson: slow and steady stewardship typically serves long-term investors far better than aggressive, opaque expansion. Watch for complexity, many debt types, warrants, strange accounting. It often hides risk. Pair 2, Air Products versus Air Reduction. Contrast: 2 gas companies. Air Products had stronger profitability and growth, and therefore a much higher PE ratio. Air Reduction was cheaper but steadier. Lesson: higher quality can justify a premium, but buying the cheaper, solid business can pay off in aggregate. Don't assume expensive equals better for your portfolio without examining price versus future reward. Pair 3, American Home Products versus American Hospital Supply. Contrast: both big healthcare-related businesses with lots of goodwill. Both richly priced. Hospital had higher growth but lower return on capital. Lesson: when both price and goodwill are large, you're paying for future performance. Conservative investors should be cautious. Goodwill is fragile if future earnings slow. Pair 4, H&R Block versus Bluebell. Contrast: H&R Block had explosive growth from a small base, huge PE ratio. Bluebell is a steady, older manufacturer with modest PE ratio and strong dividend. Lesson: momentum stocks can soar, but they also carry risk. Good companies with reasonable prices, Bluebell, often deliver better long-term value than a very expensive hot story. Pair 5, International Flavors and Fragrances, IFF, versus International Harvester. Contrast: IFF is a small business with high margins and fast growth. Harvester is a giant, low-profitability company. The market valued IFF far higher despite having much smaller scale. Lesson: profitability and growth drive valuation. Size alone is not safety. A big company with poor returns can be a poor investment even at low prices. Pair 6, McGraw-Edison versus McGraw-Hill. Contrast: Edison, industrial, looked reasonably priced. Hill, publishing and information supplier, traded at very high multiples based on market enthusiasm. Hill's earnings started to drop, and the stock fell sharply. Lesson: popular sectors can become overvalued quickly. Momentum can reverse. Check whether high valuations are supported by stable earnings trends. Pair 7, National General versus National Presto. Contrast: General is a sprawling conglomerate with warrants, convertibles, and huge dilution potential. Presto is a small, simple, profitable, conservatively run company. General's true earnings multiple is astronomical once you count warrants. Lesson: always account for dilution, warrants, convertibles. Corporate complexity often masks true valuation. Simple structures often win for cautious investors. Pair 8, Whiting versus Wilcox & Gibbs. Contrast: Whiting is a long-lived, steady business, reasonable dividend. Wilcox & Gibbs is an odd, diverse conglomerate with poor results. Market mispriced them at times. Lesson: longevity, clear business focus, steady dividends. Those are useful signals. Don't be swayed by name similarity or temporary market noise. Here are some general themes Graham emphasizes. 1. Price does not equal value. Good business does not always mean a good buy. Cheap price doesn't always mean bad business. 2. Watch leverage and accounting tricks. Big debt, deferred assets, unusual reserves, massive goodwill, and many classes of securities, warrants, convertibles are red flags. 3. Momentum can be misleading. The market often outruns fundamental value, rewarding glamour for a time and punishing it later. 4. prefer clarity and simplicity. Clean balance sheets and consistent earnings histories are easier to analyze and usually safer. 5. Diversification matters. If you take risks on a high flyer, limit the exposure and keep a solid base of sensible holdings. The chapter's contrasts are timeless. The commentary gives many modern parallels. Dot-com IPOs and tech bubbles. Hot small companies valued astronomically versus steady industrials. Conglomerates that grow by acquisition then write down value, and companies that hide weakness in footnotes. And the final note. Markets can vote irrationally in the short run, but over time fundamentals matter. Here is a quick practical checklist when you look at a stock. Look at earnings stability and trend, past 5 to 10 years. Check return on capital and profit margin. Is the business efficient? Review balance sheet, debt levels, current ratio, off-balance items, big goodwill. Search for dilution, convertibles, warrants, stock options. Compute diluted shares. Ask how much of value is goodwill/intangible versus tangible assets. Judge whether the current PE ratio and price-to-book ratio require heroic future growth. If it's a hot IPO or sector darling require extra skepticism, the market can be wildly wrong. Bottom line, Chapter 18 is a gallery of contrasts. Conservative versus speculative, simple versus complex, steady versus trendy. Read the numbers, not the headlines. If you do the arithmetic and mind the footnotes, you'll avoid many of the painful surprises, Graham documents, and you'll be better prepared to spot the genuine bargains when they appear.